We seem to have a critical mass. We're almost getting to critical mass, so I think we can get started. Good afternoon and welcome, everybody. My name is Elizabeth Ferty, and I am a financial journalist. And it is my pleasure to be joined today by two luminaries in our specified field. Today, we're going to be talking about proxy voting. The title of our webinar is Sustainable Stewardship at the Crossroads, the Role of Proxy Voting. And it's the third in a series, an ESG full series run by Solactive. So thank you very much for being with us, Sarah and Kim. I'll let you introduce yourselves shortly. The way we're going to run this today, we have a 45-minute chat session between us three, or maybe these two. I should be posing the questions, not answering them. And after this time, we will have a live Q&A. So please, if you can see on the bottom of your screen, there is the Q&A box. Please start thinking about the questions you'd like to ask Sarah and Kim, because this is about you as it is about me. So without further ado, Sarah Wilson, please could you tell the audience who you are, where you come from, and why you're here with us today?
Thank you very much, Liz. So good afternoon, everybody, and thanks for joining this webinar. As Liz said, I'm Sarah Wilson. I'm the Chief Executive of Minerva Analytics. So Minerva has been in the proxy voting business since December 1995, when Manifest, one of our subsidiary companies, was originally set up. So I'm here based in the UK, in sunny Essex. Well, not very sunny Essex, because it's pouring down with rain. And so since lockdown, we have been running our global voting and research solution from our various homes scattered around the world, including Australia, Spain and China, as well as the UK.
Great, thank you, Sarah. I'll just pop in now that I'm in the sunny Canary Islands, where it hasn't rained in literally weeks. Kim, where in the world are you? What do you do? Where do you work? And why are you on this panel?
Perfect. Well, I'm based in London, which, much like Sarah, is not very sunny, so I'm very jealous of the Canary Islands. So I work for a company called Barnett Waddingham. I sit within our investment consulting practice, and I'm part of our sort of manager research and ESG research team. And so a part of my research is individual investment products, but the other part of the research is stewardship, so engagement, proxy voting, which is obviously what we're talking about today, and sort of that for pension schemes, endowments, charities, and just a range of sort of institutional investors.
Fantastic. Right. As I mentioned, we're here with some very, very good company. So we're talking today about proxy voting. And arguably, proxy voting has never been more important. The voice of the asset owner is increasingly crucial. And we're seeing how the asset owner can actually turn tides on sustainability issues, looking at the fossil fuel sector, looking at corporate responsibility too. So if you could, ladies, we know what proxy voting is. We know you have to put a tick in a box at a certain time of year. What's happening now? Can you bring us up to speed with how investors are using proxy voting in practice? And if we could look at what's happening, the take-up of this, are more people voting, what's happening in different regions, are any typical investors getting involved? Are we, pension funds, sovereign wealth funds? Who's really making the run for it, and why, and what's been the driving force behind all of this? So, Sarah, if I could start with you, please.
Sure. So 25 years ago, proxy voting was relatively new. Voting turnout levels, when we first started measuring them, were a staggering 25%. So that meant that 25% of shareholders were actually voting their shares. Today, on average, they are around 70 to 75%, depending on the size of the company. And that's pretty much a universal number. That's more or less around the world. So institutional investors, having got into the swing of voting, are doing it pretty much everywhere. But the issues are what is changing. 25 years ago, the concern was about, has the board got a joint chairman and chief executive? Is there an audit committee? Is it independent? So they were structural issues, getting the governance into the right shape. Today, what we see is a much more nuanced approach to proxy voting, which is looking at the qualities of the company. So it's not all about the inputs. It's about the outputs. What is the company doing? How is it doing it? Are they accountable to the shareholders and increasingly the stakeholders? And for what issues? And what we have seen, particularly in the last 3 to 4 years, are more ESG conscious investors realizing that they don't necessarily need a shareholder resolution to make a point about an issue. And we've seen a number of investors now coming public and saying, well, 10 years ago, we might have voted against a joint chairman and chief executive. Now we're probably going to vote against the chair if this company has not signed up to TCFD or Transition Pathway Initiative, for example. So there are also some mechanisms which are changing thanks to the Shareholder Rights Directive. So recognition that the proxy plumbing on a cross-border basis needs to improve dramatically.
Right, so it sounds like we're heading towards a maturity within the proxy voting stakes that in 1995 was certainly not what we are now.
Yeah, I think that's right. So you might say that the technology is getting, in parts getting better. There are some other issues which are quite complicated which need to be addressed. But the way that the tools are being used is changing. And the who is using the tools is also changing because we're seeing much more demand. I think Kimberley will probably talk to this. The trustees of schemes, the actual providers of the capital now have opinions and they're not afraid to raise those opinions and actually often use that as a basis in the beauty parade for whether or not, even if it's a tiebreaker. And just yesterday I was speaking to a manager and he said, well, we've gone to all this trouble to design our investment beliefs and this fund. We want to make sure that we are voting in alignment with our beliefs. So no, we don't just want to set a standing instruction with the custodian to do robo-voting.
Right, interesting. And Kimberley, obviously you're very close to investors too at Barnett Waddingham. What are you seeing the current state of play? What else can you add?
Yeah, I think Sarah made a really great point in that there's definitely a much bigger focus on proxy voting now. And I think sort of over the last few years, as investors have sort of started, putting in place their ESG policy, considering, really what their asset managers are doing within their investment decision making, they've also realized that this is a really fundamental part of that ESG policy. And so what they're trying to do is they're using proxy voting and, sort of wider stewardship efforts to actually implement their policy. And there are some investors who are sort of still on this, this ESG journey. And so they may not be changing their investment strategy yet, but what they might be doing is they might be saying, I've still got these ESG beliefs and I've still got this ESG policy within my current investments. I would like to reflect that and I would like to vote in accordance with that. And so I think there's a much bigger focus on the role of proxy voting. And I think there's definitely been a shift. A couple of years ago, it was very much, well, is my manager voting on my behalf? And I think that was the focus. It was really getting people to actually carry out the proxy voting. And I think there's definitely been a shift from that mindset to, okay, well, how is my manager voting? Now I want you to tell me why you're voting. I want you to tell me what those key votes are. I want you to tell me if you voted against management or for management, why you've done that. And I think that there's increasingly becoming a shift at the moment. I think we'll see this a bit more in the future where it's not only tell me how you voted, but tell me how your engagement has backed up your voting. Tell me about your entire stewardship efforts. I don't want to know just about the proxy voting. I want to know how your proxy voting reflects your engagement efforts as well. And so I think thinking about it holistically and thinking about it as actually a fundamental part of your investment strategy has definitely been a really big shift that we've seen.
Yeah, and that connection with the engagement, I think, is absolutely crucial because one of the things that we also see now is this perennial fight between divest versus engage.
Yeah.
And this is something that we've seen coming out of UN and the PRI, which is it's all very well creating rules about fund manager disclosure, rules about corporate disclosure, but if it's very robotic, if there isn't that engagement there between sort of the providers of the capital and the companies, we have seen an unfortunate tendency on the part of some companies to be dismissive about voting and about engagement, accusing investors of kind of just blindly box ticking and not really understanding why this matters so much. So we're definitely seeing supportive regulation Whereas before it was really kind of binary. Now we're seeing, well, if not, why not? Apply and explain. And I think that companies are starting to realise it's much more nuanced than just sort of hitting the company around the head with a piece of 2x4. Is that it's an invitation to have a conversation. And one of the things that we've also noticed recently is how on the credit side, on the fixed income side, the voting, when it happens on the fixed income side, is usually because there's about to be a catastrophe and something has gone really badly wrong. So it's that virtuous circle of the engagement backed up by the voting and sort of representing the views of people whose money is at risk. So let's never forget that. Money is at risk. And so how are we protecting money from unnecessary risk? And voting is all part of that. It's not an afterthought, because actually voting is the same legal right as the right to buy and sell shares. And a lot of people don't realise that. So it's all about how are we protecting downside risk as much as finding alpha along the way.
Mm-hmm. And Kim, as an investment consultant, do you think there's a broader understanding now that ESG is as a full package, and with stewardship involved, it isn't just about doing the right thing. It's about, as you say, Sarah, it's about protecting your money. And the risk is, if you get all this stuff wrong and if you just don't even think about it, you could actually lose money and your members won't get their benefits potentially, or if you're a sovereign wealth fund, you can't fund it, whatever it might be. Is there a broader understanding then that proxy voting is part of a wider stewardship piece which will help protect income?
Absolutely. And I think in the past, potentially one of the barriers to sort of proxy voting was it is quite difficult to sort of take an individual resolution and tie that to, well, and this is the effect on the share price from, confirming your auditor or whatever it is that you voted on. You can't do that particular attribution. And so I think the recognition, the increasing sort of body of evidence that shows that by incorporating ESG and taking ESG into account in your investments, including proxy voting and stewardship, is that actually that does help protect your investment returns. It helps mitigate particular risks. I think that has sort of confirmed for people the importance of this, and they should be taking this to account, and that actually for quite a lot of people in sort of some of the passive management funds, they were doing this 10 years ago in varying levels of engagement and varying levels of how much they were actually voting, but they were doing it 10 years ago. It's just that now they're still doing it on your behalf. You need to take ownership of how they're doing it. You need to make sure that they're doing it in the way that you would like them to do it.
And how has regulation helped? Because I know regulation is very different all over the world, and what happens in the UK is different to what happens in Europe now, and what happens in Asia is different to the US, and on we go. How have you seen the role of proxy voting as a thing, as part of a wider stewardship push, either helped, hindered, just kind of let to go in its merry way by the regulators? Because it seemed to have been an interesting couple of years, if I remember rightly.
Yeah.
So I'll let you go first.
It's been an interesting few years. It is fair to say that after sort of the global financial crisis, there was, in the US, you had the passage of the Dodd-Frank Act. We had the introduction of Shareholder Rights 1, which evolved into Shareholder Rights 2. We saw a lot of lobbying against ESG, against proxy advisors, against shareholder involvement. Shareholders don't know what that is. And there has definitely been this sort of concerted lobby against the whole process, which is, I think, incredibly disappointing. But Shareholder Rights 2 actually was a much less worse directive than it could have been, and actually has been useful to sort of put a stake in the ground to say, things were not happening the way that they should have done. Unbundling of voting from custody wasn't happening. You had a complex chain of intermediaries, which was unduly complex. And that actually goes back to the global financial crisis. We were asked by Bank of England and other regulators after the Lehman's collapse, why is it people couldn't find out where their shares were? And we said, well, there is a problem of identification. who owns these assets, and we'll probably come on to that when we talk about implementation statements, but it actually identified there were these weaknesses which contributed to poor quality engagement. Companies didn't know who their shareholders were. They genuinely did not know who their shareholders were. So they made these assumptions about fund managers and proxy advisors. That is now starting to change. So transparency is a good thing. On its own, it's not perfect because it's nuanced, and there have to be explanations about it. But regulators are no longer just creating sort of blunt instruments. They are thinking about the consequences of regulation. They're much more about principles, whereas the US regulations were do it, don't do it. So you had, in some instances, very lowest common denominator box ticking just to comply. Whereas Europe has, and the UK and Europe are completely aligned on SRD2, notwithstanding the B word. And so now it's much more about explain what you're doing, help the consumer understand why you're doing it better than the person around the corner. So it's just at the moment, there's an awful lot of it. So we've got a lot of indigestion. We've got, in the UK, we've got the Pensions Act and implementation statements. In Europe, there's the Green Taxonomy. Shareholder Rights Directive is still working its way through. Stewardship codes around the world are forever being updated. So like once every 2 years, there's an update cycle on those. So it does sometimes feel a little bit like we're in a hamster wheel, just going around keeping up with the regulations. But a lot of them do have facets in common, which is good. And I think the fact that the UN and sort of the whole push on the SDGs is now sort of, you see TCFD and the Financial Stability Board saying, you know, maybe we need some harmonized standards. That's good. And so I'm not going to complain. Yes, it's hard work, but it's actually sort of pushing us all in the right direction.
Mm-hmm. And I'm pleased that you're not going to complain about it. It does sound right, but it does sound very confusing. So, Kim, you must meet with pension schemes pretty much most days, and probably most weekends, because pension schemes are like the work never stops. Do you think that there's maybe a little bit too much? Are people a bit kind of bamboozled because they're being told by regulators that they have to do things? They're being told by members that they've got, how do you kind of simplify and streamline it so that trustees know what they're meant to do and not what they're not meant to do? And how does this all kind of come together?
Exactly how it all fits together. Yeah, it is quite difficult. I think there's been a lot that's come through at a pace that potentially pensions aren't quite used to. That pensions isn't necessarily the quickest moving industry in the world. And so recently a lot of stuff has come in, and there has been reasonably short deadlines for actually when you need to be doing this, how long you've got to prepare for it. And so it has felt like the last couple of years, it's very sort of bang, bang, bang with your timelines. But I think, like Sarah sort of mentioned, there is sort of harmony with some of the stuff that's coming in. And so you can sort of see it coming together slowly. I think explaining to sort of schemes why it's happening and what sort of the point is, I think that's sort of the main thing. I think as soon as you start thinking about it like a tick box exercise, so like the implementation statements that lots of schemes are starting to prepare at the moment, it can seem a little bit, I just write down what I did, what's in my SIP, what my manager did, and then I'm done. Sort of, that's not really it's not the spirit of what it's meant to do. And actually, if you do it like that, you're not getting value from something that you are putting together and putting time and effort into, and you're not you're not really going to get much from that. And sort of, as new things come in, actually, you're going to start falling behind the more you think about this like a tick box exercise. But I think as soon as you sort of, use your implementation point and reflect on what you've done and what's in your SIP, and then you sort of think about, well, actually, when I was doing my manager selection exercise, I was thinking about the ESG characteristics of this fund, and that reflects my policy in this way. And it does start to come together. I think it's the role of us, of consultants, to sort of be highlighting all these bits as you move through this with the scheme and with your clients, because I think that is sort of, it can be tricky to see exactly how you're getting benefit from this sometimes. And so, but I think that is our job. I think that's sort of saying, actually, look, you've done this bit of work. Now let's think about your strategy. Now let's think about the funds that you're in. What are your values? What is your ESG policy? And by doing that, then actually it does start to come together. And I think sort of as it beds in a little bit more, it will get much, much easier. I think we're sort of at that pinch point now where quite a lot has happened and people are going, oh, this is quite a lot. But I think that will pass.
Yeah, and we've had, of course, this year, we're all sitting in different parts of the world, some warmer than others, have to keep getting that in, because COVID-19 clearly was something that nobody was prepared for. But it seems that when we want to be nimble, we can be, and virtual AGMs, whether you love them or hate them, have served a purpose. How do you see that going forward? Because it seems there's some support for it. Some people think it's okay, some think it's not far enough. But essentially, everyone needs to be. We need tools to make this happen. We can't just do this on a Zoom call with 8 million shareholders. Even though it will be quite good fun. Sarah, what do you think the next step is, I suppose, for virtual AGMs to make sure that everybody gets their say, whether, I suppose, a retail investor or one of the world's biggest pension schemes? What's the next step, do you think?
Okay. So this actually raises some very interesting points, and actually we've had a question come in which I can answer at the same time as this. And the problem with virtual AGMs is knowing who is a shareholder, who is entitled to vote at a meeting, because this is not just like, I'm going to rock up to a Zoom meeting. This is a little bit like a general election. It has a very, very important legal impact on the company. So virtual meetings, split voting, what's the connection? The connection is who is a shareholder, who is entitled to say things and do things, and does the company know that it is genuinely the shareholder on the other end of the call? So that's the mechanics end. But then there's also the kind of the more philosophical component of this, which is one of the things about Zoom and Zoom fatigue that we've all experienced, whether it's Zoom fatigue or Teams fatigue or Blue Jeans fatigue, is where you know people already, you can maintain a relationship, and that's good. But the introduction of that sort of glass, as it were, between you creates an impersonality where it's very easy just to shut people out. Whereas if you're in a hall and you're talking to people, and you're seeing them directly and you're looking them in the eye directly, that creates a different dynamic for that accountability. So the shareholders are no longer faceless. They are real people looking after real money. And I always say to my team, when you're doing proxy research, I want you to remember, this is about the dinner lady. This is about the lollipop lady. This is their pension. They'll get maybe a pension of £7,000 a year, and every penny for them matters, and the performance of those investments matters. So it's actually about connecting ordinary people and their money and making sure that their money is being looked after properly. And this is why, along with the virtual meetings and sort of getting wider exposure to different points of view on the company side, the trustees also want to have their voice heard. So rather than saying, well, manager, I bought you because you're like super cheap. Actually, your stewardship sucks. So therefore, I will take you for cheap fund management. But what I want you to do is implement my voting policy instead. And that's actually where I see at the moment there's a much bigger tension. I think that the regulators are conscious that there are drawbacks in the virtual AGM process, which company law can address quite quickly. But there are more issues in the complex chain of ownership from the fund through to the saver, which I think are now just only being scratched. But the virtual AGM process has really identified this. So I'm predicting that we'll see some things moving quite quickly. You cannot have a situation where a chairman just preemptorily shuts down a meeting, and people are only allowed to send, 5 questions 4 hours before the meeting or whatever. That's got to change, because as there's more demand coming through from the beneficial owners to know, well, why have you not implemented climate change? We actually want to hear why you're spending a small fortune on lobbying against climate change. So a little bit like the internet has upended the whole sort of democratic process that we see at the government level, we're starting to see that happening at the corporate level as well. So it's interesting times for sure.
And Kim, what's your take on this? How have your clients at Barnett Waddingham been reacting to? I'd love to go to a virtual AGM, but I'd also like to go to an actual AGM because I think you get free lunch from what I or you used to back in the good old days. What have your clients been saying about this process? What do they think need to change? I presume that only the most engaged ones would go. I don't know. What's your feedback on it?
Yeah, I think Sarah's made a really good point in that the majority of clients, they want to know that their proxy voting is being undertaken responsibly by their managers. And if that being done in a virtual environment isn't working, then that is going to raise a lot of issues for clients. And I think that needs to be solved, because I think obviously sort of this year, there was a global pandemic. You sort of have to make do. But going forward, if you're going to have these sorts of virtual AGMs, then the beneficial owners' views have to be reflected to the asset managers, and the asset managers need to be able to conduct that proxy voting appropriately. So I think that is definitely something that people haven't been overtly worried about yet, but going forward, it's definitely something people are keeping an eye on, because this is a really important part of that sort of ESG policy that they're trying to implement. So I think if it stops them from being able to do that, then it starts to become a really big issue.
Mm. And what have you seen from the manager side of it? I must admit, I get press releases every couple of minutes from managers. I don't think I've had one about what they're doing about virtual AGMs, or indeed any kind of AGMs at all. What have you seen, without being too, well, actually do be controversial, how have managers been adapting and reacting to the virtual AGMs, Kim?
Yeah, I think it is quite difficult. I think we've had some have been quite vocal in not liking the virtual environment, and I think they tend to be the managers who are more engaged in the proxy voting and the stewardship process. I think it has sort of potentially unintentionally highlighted some of the managers that maybe aren't quite as engaged. If you're not worried about these types of issues, then maybe you're not as engaged as you need to be. And if this is something that you're thinking about now, if you're thinking about how you're going to be able to operate in a virtual environment, if that's what we have to do, then maybe you are on the more engaged scale, and maybe that's something that clients and consultants need to be taking into account.
Mm-hmm. I've also just noticed my light keeps changing, and I keep looking like I'm on some kind of witness protection program. So I'm really sorry, but I'm in a sunny place. I shouldn't apologise too much. Sarah, a question's come in that you'd like to answer. Do you want to answer that now, or should we wait a little bit later? Does that link with what we're talking about now?
No, I think it's actually a good one. And so it was a dear anonymous attendee who asked the question. So talking about transparency and the relationship, the different forms of transparency, their impact on proxy voting. So we've got ETFs, mutual funds, asset managers. We often talk about asset owners and asset managers like there's just these two big buckets, and that they're all the same and they all exhibit the same characteristics. And you've also heard me use that terrible word that came out of the European Commission, the complex chain of intermediaries. And this is actually a genuine problem. The way that and it actually goes back to directed voting again, even, is the way that many of these funds are actually created, the involvement of platforms, mancos, custodians, stock being put into pooled accounts. The companies do get incredibly frustrated. I have long been an advocate, and I've often said, there is no reason why securities should not all be in designated accounts. Everybody gets maximum protection. Back in the 90s, we were talking about, why can't we have an investor ISIN so that everybody can know who everybody is, rather than filling in all these wretched forms and sending them back to the company. Obviously, now that's morphed into the legal entity identifier, which I think is a fantastic sort of creation. But yeah, I think that the people who are running platforms and running mancos, they're doing something which is socially useful, absolutely, in creating efficient mechanisms to run funds, but they have unintended consequences for the transparency of the ownership, which actually has knock-on implications for the fund management company itself in terms of layering on lots of costs, and that's not good for efficient markets. So SRD2 is not the end of the process. It's actually the beginning of a new set of processes, out of which are going to come a lot of head scratching, and people are going to say, well, we still can't see who our shareholders are. I think ETFs have got some fantastic opportunities for people to sort of create, oh, I want a TCFD oriented ETF. I want an SDG 13 oriented ETF. And you get some fantastic creative opportunities coming in. So I think, on balance, they are a good thing. The downside is I think we've got to take a look at the admin issues to actually say, is this as streamlined as it can be? Is there unnecessary intermediation in here, which is getting in the way? But yeah, I wouldn't be at all surprised if somebody within the next year says, I'm going to set up an ETF and we're going to have client-directed voting on this. And so this is going to be the people's ETF with the people's voting policy. I can see that as being a totally feasible thing. And I think that initiatives like Make My Money Matter, so Richard Curtis's thing, if anybody's not from the UK, Richard Curtis for Weddings and a Funeral, etc., he's actually now throwing a lot of his sort of a personal effort behind a campaign which is designed to get ordinary people who might otherwise not understand what the stock market is involved in their investments and savings, so that they can actually understand that their money does make a difference. So I think ETFs have got a great part to play. Are they playing as much a part as they could do? If you look at the Stewardship Code signatories list, not many ETFs involved in that. Nope. So a lot of them maybe are quant thinking, oh, well, I'll create a quant fund and it's going to have these characteristics. And then you say, so what about the voting then? And that's kind of not thought about that. So I do think that is an area that people are going to be looking a little bit closer.
Okay, and I want to step a little bit further on from that, because we said at the beginning of the show that the takeover of proxy voting has rocketed really much higher. And there was a survey out today in the US. It was about high net worth individuals, and they have said that during this COVID-19 pandemic, they now will assess what a company has done for its employees, for its clients, and I didn't read the full thing, shareholders might have been in there, but they said they're really taking this into account now before they commit their capital. And as we're all clearly high net worth individuals on this call, I think we could all agree with that. And I think the Richard Curtis initiatives are really strong one too. How do we get from, we were at 25% of shares being voted, now 75%, how do we get up to the next bit? How do we convince people? Because I could go to my fund managers who manage my personal pension, all £15.87 of it, and say, hey, I want you to come and do this. I don't know if he's going to listen. But how do we, what's stopping people voting their entitlements, essentially? Kim, what do you, when your clients say, I can't be bothered, or is it too difficult, or is it what are the main reasons?
Yeah, I think there's a couple of reasons. There's in terms of not necessarily voting, but getting your proxy voted the way that you want, in line with your policy. I think a lot of the issue there is for a lot of potentially smaller institutional investors, size is quite a big issue, because you're normally investing through a pooled vehicle, and so when you delegate that investment manager, you're also delegating the proxy voting. And so a lot of index providers, they will block vote across the way, so they'll cast one vote on behalf of their entire organization. And so essentially what they want to do is they want to be able to do that on the one resolution, vote their entire book. And so your policies aren't necessarily being reflected in that. And it would actually be quite a difference to be able to have to split the vote in between every single pool of assets for every single client. And so there are initiatives out there. So there's one in the UK by the Association for Member Nominated Trustees. Mm-hmm. It's called red line voting. And so basically there's a series of red lines, and you can sign up to it and show it to your asset manager and say, look, these are the red lines that I've signed up to, and this is how I would like you to vote my proxies. You can't currently make anyone vote your proxies that way, but the idea is that if you get sort of enough small schemes signing up to this, or enough small institutional investors, that will sort of sway the tide a little bit, and sort of get your views hopefully recognised a little bit more by your asset managers. So I think for institutional investors who not necessarily want the voting to increase, but want their views to be reflected in the voting, I think that is quite a big issue. There is some sort of changes in terms of getting people engaged with their pension through voting. There is some tech that's sort of coming out at the moment. So there's one particular app that I've sort of seen, and basically what it will do is someone can log in, it will show you what companies you're currently investing with your pension and show you the resolutions that are coming up, and it will ask you actually how you would like to vote on that particular resolution. So no one is bound by how you would like to vote, but actually it's a great way, I think, for some investors, particularly, well, it's a great way for pension schemes to sort of get your member views, which is something that schemes are trying to do a lot more nowadays. It's a great way to get your member views and also get that confidence that the way that your voting policy is actually in line with what your members want, which is a really big thing. And I think by getting members involved, they put pressure on schemes, who put pressure on asset managers who do the voting. And I think it's almost this chain of, I want you to do this on my behalf. And I think that's sort of what has to happen in the industry at the moment. It has to come from lots of different places and almost create that sort of wave to get us up to that 100% voting mark.
It does seem like, and that sounds fantastic. I'd love to have that. Like, vote this, vote that. I'd love that.
I know.
But it seems that with everything that pension schemes have to take on, and let's not forget, most pension trustees don't really get any thanks or any extra anything just for doing it. Do you think it all seems a little bit overwhelming? And of course, all trustees are doing it because they want better and a more secure retirement benefits for their mates, their members, everybody. But do you think it can be a bit overwhelming? Because as you're talking, if we set the structure up, then it can happen. But do you think there is a sense of, oh God, this is just a bit too much like, I've got everything else to do. So how do we kind of get around that?
Yeah, I think there's sort of two bits to it. I think not everything has to happen now. You don't have to be perfect now. And I think sometimes when we talk about solutions, we talk about, in an ideal world, this is what we'll be doing. And I think actually no one really is in an ideal world. Everyone's starting where they are. And so it just has to be incremental. It just has to be, what can you do now? What's that quick win? What's the easy win? Where do we want to get to? And what time frame are we looking to get there over? And I don't think any scheme, any investor should believe that next week they're going to have all this stuff implemented. And I think the rest of the sort of second part is the rest of the industry. I think the more solutions we can build into one place, actually the better. So that's sort of the product I was just talking about. I think there's multiple benefits from it. There's increased member engagement. There's support behind your voting policy. There's so many good things that come actually just from one app, which hopefully it's your members doing all the work and putting in their votes rather than you. So I think behalf of the industry, sort of the innovation that comes out, the more things you can do in one place, the better. And then also just not trying to be perfect tomorrow. I think doing what you can when you can, and we'll get there.
Yeah, there is definitely an opportunity here for not just for technology to make things easier, because certainly we've recognised through the implementation statements process there are some investment administration gaps, massive, in actually be able to connect people. So in terms of building back better, I think we've all got to step up and say there are some intractable problems, or there have been some intractable problems over the last 25 years, which have, for whatever reason, divorced people from their money, and we can't have that. So technology, without doubt, plays a part. And what I've been saying to the managers I've been speaking to is, this is probably the best opportunity you've had for the quarter of the century to really show off what you are doing. There is so much good stuff goes on in ESG teams. We know about it. We're cursed with knowledge. We know these people really well. We've been to conferences together. In an ordinary world, we'd be at the bar afterwards nattering about it. And so just how committed and enthusiastic these people are. Sometimes, though, they are just stymied by the lack of either internal support or infrastructure, which, I speak to them and they say, oh, God, we're so overwhelmed. We've got this initiative, that initiative, the other initiative. I'm spending all my time filling out forms. I'm not doing the engagement. And so, we're doing a lot of work with people, helping them. We call it vote tech now. Because, all of a sudden I'm cool. Like 25 years ago, I couldn't explain to anybody what I did. Now I can just say, oh, yeah, I do fintech and it's vote tech. And, oh, yeah, that's fine. I mean, the laughable thing is obviously back in the 80s, when I got my apprenticeship in the city, we went to this event called Computers in the City, because we were moving from pen and paper ledgers through to computer ledgers. I was asked the other day by our custodian, oh, can we have your fax number? And I just said, sorry, excuse me. Oh, yeah, we might need a fax backup. And I just thought, oh, no, are we still using wax tablets and cuneiform here in ESG? I hope not. So there does need to be an injection of time and resources, not sort of somebody doing this as their side gig, but actually CEOs saying, you know what, this is actually a key product differentiator. We either step up to the plate on ESG and we're doing it soup to nuts, or we're just not going to exist, because, Darwin never said anything about survival of the fittest. Darwin talked about the most adaptable. You don't have to be a ginormous top 5 investor to do ESG really well. In fact, some of the most innovative things that have happened in ESG have come out of those managers who are maybe smaller active managers who can get hands-on with their companies and really understand them. Index managers have a different role to play, which is they are permanent investors. It's a weight of money. I hate it when people talk about it being passive, because it's not passive. So I think everybody's got a part to play, but we just need to take a little bit of stock to actually say, where do we need to fix what bits? I'm not sure we ever will get to 100%. I worried with the miners review that we had in the UK that the focus was more about quantum than about quality. So there have been lots of accusations about robo-voting, so where people just do set and forget voting. And that is pointless. That just obliterates the thoughtful votes. And so I've often said to people, if you really don't want to vote, please just don't vote. Just don't bother voting at all, because then all that's happening is the company gets a false sense of security, thinking it's got shareholders in favour. And there's a big difference between shareholders in favour and those who are just indifferent.
Yeah, I think that's a really great point that you've made, actually, about, there's no point in voting if you're not going to do it properly, because one of the discussions we've had recently is people are sort of looking at managers and sort of saying, oh, well, this manager voted against management 17% of the time, the other one only did 4% of the time, they must be better. Does that mean that they're better? When actually it's absolutely not the case. You want to know that your manager's willing to vote against management if that's what's right for you. But actually it's not necessarily about how much they voted for, how much they voted against. It's the consideration behind those decisions, which is the really important thing.
Absolutely. So when we started, the thing that we did was we said, well, we're not going to have a house policy. We're going to treat this like any other part of investment, which is to say you'll have a manager over here who's got this view, a manager over here who's got this view. We'll let the regulators set the best practice frameworks. And actually, we're now coming full circle. And that we're actually now seeing people saying, well, actually, I'm going to have a custom policy versus a house policy. And I think that's actually a really good thing. But yeah, sometimes these things take 25 years or whatever before people can have that collective aha moment. So it's great when you see leadership of some funds coming out, and it's not always the usual suspects coming out and saying, yeah, we're going to think about TCFD. We're going to implement TCFD in our reporting and in our voting and in our stock selection. And so now ESG teams also are coming together, where previously they were often and invariably two separate groups. And there was often not much love lost between them because they just operated in different ways. But definitely in the last 5 years, we've seen how they are being brought together, and they use that overused word, the synergies. The synergies of those two teams coming together has really accelerated the whole debate around sustainable stewardship.
I'm gonna open the floor or open up to questions now. So everybody in online platform land, please do send your questions in. Whilst we're waiting for them, I've got it's a provocative one. We've been talking about ESG teams and how good they are, and you're saying, Sarah, that sometimes the fund managers and the ESG teams don't often see eye to eye. How long do you think it's going to be until, or will we ever get there, that we don't actually have an ESG team with a fund manager? Everything is just embodied within the portfolio management team, and they understand that voting can be really powerful and that stewardship is a really important part of their job. Do you think we'll get there, or is that the utopia that we're all working towards, but we may never get there, or if we do, then we will be dead and gone because it will take forever?
Do you mean go back there? Because that's actually how it used to be, oddly enough. I'd
love to say it was before my time. It probably wasn't, Sarah. Paying attention.
Well, no. But seriously, yeah, there was specialisation has its value in that it enables people to sort of concentrate. What people are now saying about the growth of ESG is there's a shortage of people who've got the knowledge and the skills, and that's absolutely right. So it's great, for example, that the CFA has now got an ESG certificate. The Chartered Institute of Securities and Investments has an element of its back office certification, which talks about proxy voting. I've always felt that if governance matters, if ESG matters, this is not something that you carve out. So I've often sort of said, I don't think that there should be any ESG funds, because if we believe that this matters, everything is ESG. So why do we need to have a separate strategy for it? I understand why we did. It was simply because they had to prove that it works and that it matters. But I do, apart from maybe some very specialised funds where there are sort of religious grounds for ethical screening out of particular securities, or philanthropic funds, for example, who are sort of on that spectrum of capital. They're in the philanthropic impact sector, and so they are using their money in a particular way. Is graduate trainees will come in and hopefully spend time doing. Everybody should do 2 years in proxy voting. They will learn so much about investment in just reading the hundreds and hundreds and hundreds of proxy statements. I mean, we've just published our 10,000th sustainability report, and we nearly sort of, oh my goodness me. So yeah, it is an absolute education to go back to those basic documents. And fund managers often say, oh, yes, well, I like the quality of management. I said, well, that's governance then. I hope that there will be more, that ESG integration will mean everybody is absolutely involved in it. There will always be the need for, just as you have the economist or the chief strategist, there was always going to be that person or that group within the company where they're doing the work on sort of the understanding the emerging issues and then communicating that. But I hope that we've moved away from that's stuck in the back office and that's not done by the fund managers. But there may be, a bit like women on boards, it might be a generational shift that we have to wait for. But in comparison with the last 25 years, the previous 20 years, the last 5 years, we've seen this accelerate incredibly quickly.
Fantastic. We've got one question, but I think I'll ask, have we got any more questions? Because I have another burning one to get in before we go to that one, because I think Sarah can answer this question particularly well. But I want to come to Kimberley. So we've seen how companies and like Sarah's and initiatives like Richard Curtis, gosh, I don't think I'd ever put those two luminaries together in a sentence, but hey ho, how we can put these structures in place and work with companies and initiatives to do it. I want to look at how asset owners can come together, because we're saying you don't have to be, an APG asset management, you don't have to be a Railpen. You can just be a small biscuit factory pension fund and you can still do it. But is there strength in numbers, and are we beginning to see, because at the end of the day, pension funds don't have to compete with each other. They're not like asset managers. All they have to do is beat their own personal benchmark and everyone gets paid. Are you seeing more people come together? And if not, how do you think that might be achieved?
Yeah, no, I think we're definitely seeing people come together a lot more. I think there's a lot of education between schemes, which I think is fantastic. I think there's some incredibly large schemes who have lots of governance budget and can sort of run away and do what they want. I think particularly for small schemes, there's a lot of information sharing about great resources that they found. And I think that there's a lot of education about things that they've done. And I think that gives other smaller schemes confidence to sort of do what they want. Because I think what happens a little bit is when you're not a large investor and you don't have that much time in your governance budget to be focusing on these issues, it can feel quite isolated and quite lonely. You're not really quite sure how to get there. And so I think what we have seen is great initiative from like AMNT. I think even sort of organizations like the PRI in providing like a lot more guidance around things like stewardship and just a lot of education pieces. I think that's been incredibly helpful for schemes. And I think one thing that I think is really great is investment consultants. I know not necessarily asset owners, but in order to sort of help schemes like that, there's an investment consultant sustainability working group that's come together to sort of almost fill that gap for sort of that advisor bit as well, to sort of be like, well, how can we help these schemes in this sort of area as well?
And Sarah, carry on.
Sorry, did you want me to answer that question?
If you like, I have another one that I can answer. But if you'd like to answer the question that's come in from one of the audience, that would be great.
Well, absolutely. Well, the purpose of these webinars is not to provide blatant advertisements. So if anonymous attendee would like to get in touch with me afterwards, I'd be more than happy to show them how we can give them a say on sustainability. And I shall leave it at that.
Brilliant. Thank you. Very, very magnanimous. So if you have any more questions, the time is now. We have 7 minutes left. Where do you think the roadblocks, if we look forward to, we've talked about how these things can be achieved, if we all work together and realise the benefit of a holistic approach, and I hate the word holistic, but I'm going to use it anyway, a holistic approach to voting and stewardship together. Where do you see the roadblocks? Because we'd like to think this will all pass through smoothly, but it won't, because this is life. Sarah, where do you perceive the roadblocks?
Most technology problems are overcomable. The problem, as the song said, the problem is all inside your head. For a lot of organizations, it is just a philosophical, not invented here, this is too difficult, I've got too many other things, oh my goodness me, this is just, we're now a cost center, and this is eating into my profit margins. So I think it's time, again, here's another overused word, paradigm shift. We really are at a paradigm shift in terms of trust in finance, trust in capitalism, and trust in brands and our service providers. And I think people just have to say, look, this is a commercial imperative. We either show that we care about what our customers want out of how their money is spent. People can so much more easily these days spend their money in other ways. They are not forced into a DB scheme for the rest of their life. They can choose. They can choose to go somewhere else. So you can either offer them the choice, or they will just leave you behind. So I think it's just time for CEOs, product developers within the fund management community to listen to their ESG teams and really listen to what they're saying. Listen, read the papers, read between the lines what's being said in the papers, and just think, gosh, this is actually a really fantastic business opportunity to do good and to do good.
Great. I hope that a lot of people in our industry were listening to that, but they can get it on replay maybe. Kim, where do you foresee the roadblocks for us getting to where we need to be?
Yeah, I think at the moment, and I think this is, like Sarah said, it's incredibly overcomable, but I think the data at the moment is still one of the biggest issues. I think, sort of as an example, recently pension schemes have been putting together their implementation statements. And sort of, again, as Sarah had sort of mentioned, there's a lot of back-end admin systems that just aren't set up to be providing this type of data in the quantities and the way that people need it. And so someone sent me a 900-page PDF of every single vote that's happened over the last year, and I sort of went, I can't read this. I might start crying. So, when that is all that someone can provide to you, that has to change. This is something that isn't going away and something that is probably only going to get worse for them. So, investing in those back ends to be able to provide this will make everybody's life easier. And I think even if we sort of look away from proxy voting, really that's what we're sort of focusing on this webinar, and I think there is a massive demand at the moment for all types of ESG data. And I actually think that is growing rapidly if I think about where we were 5 years ago. And I think in particular, schemes and investors, they want the narrative from asset managers. They want the story, and they want to understand that the reasoning behind everything that's going on, but they also want to see data, and they want to see statistics, and they don't want to be greenwashed. And I think that's something that people are getting increasingly frustrated by, is sort of people saying that they're doing all these wonderful things, but they can't show it yet. And some of that is because there is a genuine issue with the data, and no one can show it yet, but it is, we will get there. And then some of it is people greenwashing.
Yeah.
But I think there is such a demand for this data that it will improve.
So we're seeing companies improve the data disclosures, but it's still patchy. There's this old joke that we've had in technology for a long time. You can have it good, you can have it cheap, you can have it fast, but you can only pick two of those three. And this is the problem that we've got. There is an element of, again, back to computing, garbage in, garbage out. Companies still disclose earnings per share in Heinz 57 variety formats. We've been arguing about accounting standards since the turn of the last century. So I think it would be dangerous to say we will wait until it is perfect. I think we've got to rub along with its imperfections and try to be as cheerful as possible about saying, this is something collectively we can resolve. After all, it's only the planet that's at stake, so nothing much. And I think from that perspective, you've got to just have a willing mindset. And those who want to send 90-page or 100-page PDFs, probably should be taken out at dawn and just sort of left on the melting ice. That is just anti-client. That's just not helpful. And why would you do that is the first thing that I would say.
Maybe they had a lot of time under lockdown. But even so, there's far too much wine in the world to be looking through that. So finally, and what you're saying is really interesting. I was at a conference a couple of months ago, in an actual conference, but it must have been a while ago. And one of the pension schemes who was talking there was talking about how they were approaching stewardship. And he said, he was basically saying what you two are saying, don't be put off because you can't get it right immediately. And he said that perfection is the enemy of success, which I thought was a really good way of kind of rounding this up. But we have 1 minute left, so I would like to ask you both, in a couple of words or less, where will proxy voting be in 10 years' time? Kim?
Just incredibly normal. I know that's a really awful way, but I just want it to be normal. I want it to be expected. I want it to be reported well, and I want it to be reported in a way that's not only useful for investors, but useful for members.
Brilliant. Sarah, in 10 years' time?
Frictionless.
Oh, good one.
Excellent. That's very good.
Yeah.
Superb. Well, and bang on the hour. I think that's everything we could have needed and more. And thank everybody, well, thank you, Sarah and Kim, for being with us. It's the hour's flown by, but the sun seems to be setting here, so you can see me now. But thank you very much for joining. Thanks to Solactive for hosting us. And don't forget, there is another one of these next week. It won't be me, but I will be tuning in because we're looking at the SDGs, how to achieve the SDGs. So sustainable stewardship at the Crossroads, achieving the SDGs. So that's going to be super interesting. Thank you all for being with us today. And yeah, let's keep pushing on proxy voting, and maybe, just maybe, we'll get there. So thanks very much, and see you all again.
Thank you very much, Elizabeth. Thank you, everybody on the call. Thanks for joining us. Bye-bye.
Thank you.
Bye.